What I want to do is I want to set the stage with a lot of analysis and research I was involved in. Half of them I was involved in. I've looked at thousands and 10,000s of startups, hundreds of thousands with Stanford across 26 countries. And what I'm sharing with you is additional insights and highlights, particularly when it comes corporates engaging with startups. And so the topic, and then we have a talk which I will moderate with a very clear structured session. Just to make sure when we talk about innovation, and we have used some of the models in Davos at the World Economic Forum, which I helped set up the venture capital group. When we talk about innovation, primarily it's technological innovation, product innovation. It's easy to measure. And I remember 15 years ago when we started doing these programs in Davos, everybody only talked about technological and product innovation. We have process innovation, and we have business model innovation. So these are the 4 layers of innovation. And in a nutshell, just to let you know, the top 3 sector leaders, and we looked at this only in the US, the top 3 sector leaders, which were startups who became top 3 sector leaders in totally new domain or area, 86% had 3 out of the 4 innovation layers, the top 3 sector leaders. Interestingly, every single one included a business innovation model as well. That's a very key message. The others don't matter, but the top 3 sector leaders had 3 layers of innovation. Another one, which I always found interesting, that no CEO, almost no CEOs that we leveraged in the workshops in Davos, when you look, and this is what I'm trying to tell you, that's why internationalization of corporates and looking outside their own home country is also very critical. If you look at, if a large multinational corporate, which is publicly listed, has 60% of or more of their R&D done outside their home country, they perform on all 4 major financial metrics: stakeholder return, operating margins, market cap, and return on assets. They outperform the ones who are more locally focused by 20 to 40%. To my surprise, almost no CEO knew this. So as a corporate VC, that's maybe one of the messages you can bring home also to your C-level executive team, because, particularly if you strive to do and look for more international deals. This was a study done with about 400 startups looking at most critical resources required. For them, this is a startup's point of view: funding, market access, technical expertise, talents, access, and business access to facilities. Very often it's R&D or distribution, and business expertise. So this is, as you can see, the relevance of importance. However, when we also look at different partners for different needs across those 6 elements which I saw before, and I'm just taking out now the yellow area, which is the corporate CVC here. It is not the funding. Let's look at this. It is market access, number 1. It is technical expertise or knowledge, number 2. It's business knowledge expertise, number 3. And only 4th is the funding. It's a very key piece to understand that. And then 5th is access to facilities or R&D labs, and then talents and acquisitions. So for each of them, you look at, you have incubators, accelerators, VCs, universities, business angels. They're different, but I deliberately carved out for this session the corporate angle to this. Main reasons startups work with CVCs and corporates. And it's access again. It's just access to resources, expertise, intro to business units. It's a big, big one, as you can see. Defined partnerships, distribution channel, market entry, capital, clean terms, potential for acquisition. It's another piece of research which was also done at a reasonably good size across many countries. So it's very consistent. And then, this is an interesting one. It's all about perception. It's about managing expectations. We'll have a discussion with this on the panel. If you look at smart capital, this is the way entrepreneurs perceive smart capital by the different investor types: corporate CVCs, private accelerators, private VCs or independent VCs, business angel, crowdfunding, friends and families and fools, the 3 Fs. And you can see that the corporates are technically highest potentially rated by the expectations of the perception of smart money from an entrepreneur's point of view. However, I'm summarizing at the high level now. The corporates were rated by entrepreneurs who did receive a corporate CVC investment, and in hindsight, sometime later, 3 years later and 6 years later, these were the results. And the results was reputational signal, delivered well. So having a corporate and aligning with a corporate and having an investment from a corporate, this was the one item where they matched, exceeded, well delivered the corporates. On the other hand, first customer, and we're going to have a discussion briefly on the panel afterwards. The expectations of entrepreneurs very often is, oh, I need this one as a first customer. Did the investor deliver or not? They called it disappointing results, under-delivered. That was the high-level message. Sales and marketing support, inadequate, was disappointing. R&D support, inadequate, severely under-delivered. HR support, inadequate, severely under-delivered. Strategic advice, little to none. I'm putting deliberately our corporates on the spot for the entrepreneurs, not the sake for the entrepreneurs, but also I want to make sure you guys as entrepreneurs understand, and our corporate panelists afterwards will explain you what and how, the do's and don'ts, and so on and so forth. This is plain vanilla, very interesting results for you entrepreneurs. I don't have the time to go through all the details of the very latest research which just came out from a large-scale survey of chief innovation officers. The greatest benefits when working with startups: it's better customer experience, more modern architecture, innovative technology, faster pace of product delivery, most cost-efficient operations, and you go on and you go on. On the other hand, the biggest challenges are limited geographical reach from a startup, concerns regarding lack of global support, lack of experience and proven track record, technological scalability concerns about financial viability of the startup, limited resources from a startup, security, compliance. These are the challenges that chief innovation officers face when they look at when their teams, their corporate teams, work with startups. Portfolio support, look at this. Even if the corporates have all the potential to deliver, this was another piece of analysis that recently was done. The biggest struggle to support startups in these areas. On the one hand, we have exactly these high expectations of startups with regard to a corporate investor and collaborator. On the other hand, when you look at, this was a survey done on corporate venture units from the heads of corporate ventures. So some of the struggles that they face, if you look at, is sales and distribution is a big challenge. Talent sourcing assistance is a challenge. Global expansion is another challenge. Knowledge sharing, including insights into customer base, is an issue. R&D facility access, brand recognition, reputation. So these are the key challenges. So if you look at, on the one hand, here are the expectations, and here are the efforts that the corporate venture team does, but yet they're facing also internal hurdles. So if I look at just the top challenges faced by the survey was securely timing internal sponsorship and approval for investments, evaluating venture activities for your parent organizational through achieving strategic objectives, running timely pilots and proof of concepts, maintaining parent organizations' long-term commitments. And by the way, just in a nutshell, I was stunned. I didn't realize, it was not part of my research piece, but the average, I'm saying the average time of a corporate venture program, surprisingly to me, was 5 years. And you know what? If a corporate also has a fund, that's less than a fund cycle. Anyway, so let's see the reaction and discussion afterwards on the corporates. And then, I don't want to go into the details. The analysis was, if a new corporate venture unit is set up, within the first 2 years, here are the most important areas where they want to see returns. It significantly shifts in year 3, 4, and 5, because they're also learning, they're adapting. And they're adapting to their own organization, they're adapting to the outside world that is changing. So corporate venturing is as much in flux as a startup scaling up. It's pretty much true. And I hope, hopefully, our panelists will confirm this. So this is only an upfront information for you, stuff for you to understand. If I can ask my panelists to join me on the panel, please. And as you can see here, we have Michiel from Shell Ventures as Senior Implementation Manager. We have then, sit in any order you want, that's fine with me. Yep, no, you can take, you take it. I'll move out. Oops. Okay. Okay. So at the far end, we have Josep from Mapfre, the global head of transformation. Then next to him is Guenia from Telefonica, managing director of innovation ventures. Then in the middle, we have Sabrina from Robert Bosch VC, RBVC, for strategic partnerships and open innovation. And then we have Michiel from Shell Ventures as a senior implementation manager. And then next to me is Suzanna. Should it be Suzanna or Suzanne? Suzanna. I realize my own mistake here. From Amadeus, the head of Amadeus Ventures. So the way I'd like to do this, instead of me introducing them, let's do the following. Let's start off here, right here with Suzanna, about sort of, no, I promised you, you will be last one on this, right? But I'll start off at the far end with Josep. Make a quick introduction, who you are, what you do as a corporate venture entity.
Well, hello, my name is Josep Celaya. I'm Global Head of Transformation of the Mapfre Group, and I'm responsible for the open innovation activity of the group. Sorry. Where we have 3 main initiatives. One is an accelerator of startups, another one is a venture client, and finally a corporate venture capital activity where we are invested with other incumbents in the industry. We do investments from those vehicles, those financial vehicles where we are invested, and additionally we do some investments from the balance sheet.
Yes. Guenia. Right.
Hi, good morning. My name is Gawendo. I am responsible for Telefonica Innovation Ventures, which is the corporate vehicle for Telefonica for doing direct investments in startups and also to invest in funds, in VC funds. I think everybody knows more WIDA, no? From Telefonica. WIDA is the early stage investment. They do investments up to 150K in startups. Everything from that amount is with Telefonica Ventures. We do investments off balance sheet. We have been doing this for almost 10 years, more or less. And today we have about 10 portfolio companies invested, and we invest in other 12 funds as LPs. Our decision-making process is that we have an investment committee separately, and 2 of our executive members are members of this investment committee. The biggest challenge that we find is that the reason why Telefonica do this is to build a really strategic partners. And my challenge and our challenge is those are really hard to find.
Okay, thank you. Then Sabrina.
Hi, yeah, my name is Sabrina Jones. I am with Robert Bosch Venture Capital, and RBVC has been around for almost 12 years, so we're, I would say, quite experienced in investments. And yeah, so we have a fund structure. We're currently in our fourth fund. We operate globally. We have an office in Silicon Valley, in Israel, and since last year also in China, and of course Germany. And normally when we invest, our investment decisions are, after we check for a strategic fit, there are mostly financially driven. And so we would always also seek for a board seat in our investments. So that's sort of our investment strategy. And on top of that, and that's actually my role, is we have, just like in Josep's case, a venture client unit, also in RBVC, that is specifically dedicated to partnerships between startups and our internal business units. So we do this for our portfolio companies, but also to open to all other startups out there.
Good morning. My name is Michiel van Haersma Buma. I work for Shell Ventures. We are a team of about 35 and been in existence since 2014. We have a portfolio of about 60 companies across 3 themes. So that's oil and gas, mobility, and power. Each has a separate investment committee where we have our deal leads making the investment decisions, and in each committee we will have business representatives to buy into the strategic side of things, and that helps us subsequently on the implementation and collaboration side. We invest Series A and B typically, and we also have a global presence, so we're in China, in the United States, and also fairly big here in Europe. Our biggest challenge, I forgot to mention that. So I think we've learned a lot on the speed of implementation. I think that remains one of our biggest challenges. I think we're very eager to get better and learn learn along the way. I think that still remains one of our biggest challenges.
Good, Suzanna.
Sure. My name is Suzanna. I'm head of Amadeus Ventures, which is the startup investment program of Amadeus IT Group. So we are a technology company focused on the travel sector. So just to give you a feeling, our major customer segments are the airlines, the hotels, the airports, and travel agents around the world. So we have presence in like almost 190 countries. That's almost everywhere in the world, and have presence like in all of these cities. I think it's in more cities and countries. So coming back to the startup investment program, so we started the program back in 2013 with the objective of developing visibility on what is going on, understanding that like disruptions is around the corner. So we really need to keep our fingers on the pulse of the industry and get to know entrepreneurs who are working on exciting projects, identify the strategic partnership opportunity, and also like potentially growth opportunities as well. So far, we've made 16 investments over the years. We always focus on early stage, around Series A. We have a global mandate, even though we are actually based in Spain, like here in Madrid. So we focused on topics that enhance the end traveler's experience. So think of like your trip coming to Madrid if you are traveling from abroad, like the experience of going through the airports, checking into airlines, etc. So we see tons of opportunities for improvement. So that's kind of the area that we focus on.
Good, perfect. So now you get a sense of what they do, who they represent. So I'm asking only as an example, corporate VC activities in-house and the external ecosystem, given the team size and doing this globally like Robert Bosch Venture, RBVC does, and juggling those activities. And the way I normally sort of explain this, here on the one hand, you have the entrepreneurs, here you have the corporate parent, and here you have the CVC team in the middle. And I call this, they are the buffer between the speedboat and the tanker. And their task is not very easy. So the question is, how do you juggle those different activities. On top of it, Robert Bosch, you even have a global, massively global team around disposed in different geographies. Sabrina, what is your take on this?
Yeah, I mean, there's obviously still a lot of challenges. So I think my message to entrepreneurs would be to understand, or when you approach us in terms of getting access to our organization, our CVC team is quite small. It's like 20, 25 people. And we have to interlink and communicate with essentially 400,000 Bosch employees. So not all of them are relevant for you guys, but still there's like about 50,000 people in R&D and engineering that could potentially be a counterpart for you. And this is a very big challenge for somebody who's trying to matchmake somebody like me. So if you're an entrepreneur, it's always good if you already have an idea, for example, who's the business division that you want to talk to, or where is your angle to interlink with the organization. That definitely helps this whole process.
Okay, Guenia at Telefonica.
We have the similar challenges that we face because we are also a global company, have a presence in Brazil, rest of Europe, Spain, and dealing with all the inbound and the needs of the business units is a challenge. We in the CVC unit, we are a team of 10 people. There are 3 people, soon to be 4, based out of Silicon Valley, and the rest of the team is here in Madrid. But these 10 people, we have to manage the current portfolio of funds and startups. You have to analyze all the deal flow and close new operations, and new deals and follow-ons on the existing companies, and also try to do this matchmaking internally. So sometimes, and we know the organization because basically there are a lot of people who are in the team. There are people who really know Telefonica from the inside. So sometimes it's a challenge because we say, okay, this is the person you have to go and talk to. And then sometimes people try, and because they are really good entrepreneurs, and good entrepreneurs never give up, and they never give up so easily, So they try different doors and always end up coming back to us. So a bit of advice is trust us, when you say this is the right person. So beside the investments team, we also have a team similarly to Bosch, which is what we call the business development team. There are about 10 people in Spain and other teams, or 3 or 4 in the countries, that their job is, once we have invested, either through our funds or through the Telefonica Ventures directly or through Guaira, their job is to help these companies actually go and do business and navigate the company.
So now you can see it's not an easy task to juggle these balances in. Would you rather be an entrepreneur or rather be one of those matchmakers juggling the tanker and the speedboat? So let's look at about co-creation, innovation of startup with corporates. And this time I'm asking for a positive example, something very simply. In other words, give an example of what it was and why it was successful. Josep, if you start on your end, give a quick example what it is, what it was, and why, the reason why you think it was successful.
Well, I think in most of the cases where we have been more successful on bringing some innovation from the startup ecosystem to our organization, it's been because it's tackling a challenge that is very well acknowledged by the business. And when that challenge is already identified for the team that is working as an interface between the startup ecosystem and the organization, is much easier to plan a use case with an ordered path towards the final implementation. So I guess the key success factor by definition is the appetite of the business for a certain type of innovation. It's the job of the people that is working on the open innovation teams to identify that and find viable solutions to tackle those challenges. As a failure, I will have to acknowledge that it's actually the opposite. In some cases, we have seen very good solutions. So innovation that is coming from a startup that eventually that has the potential for changing a business process, but the business is still not aware that this is what the future is. So we have tried to push that with the even with the commitment of the top management, but the middle management has not been a facilitator.
Okay. Kenya.
I totally agree with what you said. I think that's the same reality that we live in. In terms of a concrete example of co-creation, I want to give an example of a company that Telefonica invested in 2011, and then we did the follow-on in 2014. It's a company based out of Fremont in the Bay Area. It's called Quantena. What they do is they do cheap chipsets for routers. And we invested in them with other telcos and with other financial investors. And we helped them with the roadmap. We helped them develop their product. And the thing is that all Telefonica routers around the world, they use Quantena chipsets.
Oh, really?
So
wow.
it was
Cool.
really a good value for the company. And for us, it was great because by working with them, it allowed us to disintermediate the product and build a product that is much better than the ones that were in the market, and one that is cheaper also. So it really brings a very competitive advantage for Telefonica. So the strategic value of this investment is, I can measure how much we buy from them. That's a concrete number, but the strategic value of this is really intangible. It's super hard to measure. And the financial result was really good because the company did an IPO in 2016 and it was acquired at the beginning of the year for more than €1 billion.
Okay.
So that's the perfect case. So we are looking for stories like this. That's
Who doesn't? Who doesn't? Sabrina, your story.
Yeah, we have many good examples, and I'm really glad for that. We like to showcase these good, lighthouses of partnerships with an Open Bosch Award each year in our Bosch Connected World Conference. And last year, the two winners was, one was a cooperation between our autonomous driving business division, and they teamed up with a Chinese startup who developed a LiDAR technology. So that is very successful in the co-development, and ended up our business division actually also did a minority investment in that company afterwards. So by the way, this was not the CVC who did the investment there. Sometimes the business divisions also do that. In terms of failure, I don't want to spare the failures. Because
let's keep the failure for our last point.
We're
We're coming back. This is the good story now. Let's focus right now on the good stories. We'll talk later about some of the failures too. Okay, Michiel.
Yeah, I'm going to be talking digital twins. So we've seen, I think, 13 in a dozen companies in that space. And last year we invested in one that we felt was going to be a winner. And they do structural integrity monitoring. So it's basically a health indicator for your large floating structures like you would have on your car dashboard to tell you something's right or wrong with your engine. And these are major floating structures, right? They're the size of this building almost, the size of the Eiffel Tower, really significant. Over the past year, we've managed to sign 5 contracts with this company. And they are now they are influencing multi-$100 million decisions for life extension on fields, helping urban development planning of certain areas where we have these floaters. So it's a tiny company, right? They're based in an office in Switzerland. It's about the size of this room, and they are working with Shell on some of our most material projects. So yeah, that's really the kind of things that excite me, and I'm very proud that we were able to do that.
Okay, super.
Yeah.
Suzanna.
So I would like to talk about this company that we invested in earlier this year, based out of Atlanta. It's called Volantio. The problem that they're trying to solve is for airlines to buy back the tickets that they've already sold. So imagine a scenario that I think a lot of you have experienced. Say you're getting close to knowing who is getting into the final of the Champions League game. and what happens to the flight tickets going to, like, so between the teams that are qualified and the destination where that match is going to take place. Say there is going to be very high demand. There are a lot of fans trying to go. They're willing to pay a lot of money. Unfortunately, most of the flights are already full. And so it's a technology solutions to be able to actually solicit tickets from people who have already bought them, like give them some incentives to sell if they're not going for the football match, or they can actually change the date of their travel, and offer those to people who are willing to pay more. So this is a solution. This is a company that we have invested in. And the co-creation there is, as we actually have a lot of algorithms within Amadeus to do revenue management. We see when planes are getting full. And what the startup has, it's machine learning AI algorithms to be able to identify travelers who are more likely to accept an offer, and to also modify and learn on the level of the incentives that you need to give, like in order to enhance performance, so for the airlines. So there are a lot of smart things that can do, like in a use case as specific as this. And so we made the investment, we have a commercial contract with them, we show them off to all our airlines customers, like pipeline has been great. So.
Okay. So to sum up, you can see the whole arena, a whole range of good news. I give you a very quick example of a media company, I don't mention the name, they've been in the business on doing corporate venturing for almost 2 decades. 84% of their EBITDA today comes from all venture invested companies, partially acquired, partially collaborating now. Their EBITDA, 84% today. Think of this. This is, to me, an amazing story at the very, very large scale. So we need to move quick ahead. Delivering value to startups. So we are looking at adding value here. And why do CVC corporates under-deliver? This is the touchy point question which I showed up front, saying they're under-delivered. If I can ask Michiel, your point of view on this particular issue.
Yeah, thanks, Martin.
And don't kill me, please. Okay.
I think it's a point that probably everybody at this table recognizes. To me, in general, it's about being more entrepreneur-friendly and recognizing this is a new innovation vehicle that's here to stay and is there to add value to our business. And I think there are two tactical items that that we can do better and why we might be perceived to under-deliver. So one is the C&P side of things. So being able to making it easier to work with startups and making dedicated resources available to help our startups. So having separate teams that, and you've seen that, I think, with some of our people at the table here, that make the connections between startups and business units, really foster that collaboration. But then when there is agreement to actually do something, also don't throw, major multi-million contract terms to these startups that are, very small and have all sorts of liability terms and conditions in these contracts that don't really suit the startup. So I think that's where we can do a lot better. And then the second item, I think, is around managing expectations. So I think as a corporate, we also need to be careful not to be promising the world and saying, this is what we can do for you. But these are some of our limitations. For example, longer processes in our assets that we cannot change overnight. So those are the two elements for me.
Sabrina, anything else from RBVC to add?
Yeah, I think one point why many corporates fail to deliver is, first of all, and I think a technology company is very prone to that, is there's a very strong not invented here syndrome within our own ranks. So you're the outsiders, and of course we have the best engineers. So that's something we have to overcome, obviously. And yeah, also sometimes the perception of my colleagues of what is a startup is it's just not true, because many people think startups is like 2-3 people in a garage, where we all know that's not the case. You are very successful professional companies, and so those are some reasons why there's internal, sometimes hurdles on a cultural level that we have to overcome.
Guenia, last point, quick one.
Yeah, okay. So I think you've touched this in your presentation, in the introduction. I think corporates are really not good first customers for a startup. And this is a piece of advice that we give, and when we talk to startups and when we work with them. We are great fifth, sixth customers. Once you have a product, you are already developed and something to go and scale, then then improve your product, then we are great partners. But I think to deliver value to startups, we need to know when it's the right moment to interfere. And also, I think startups need to learn and say no, because if you don't say no, corporates will start asking for more and more and more and without committing. So I think those are the two pieces of things that we try to deal with by being when we are in the middle of this relationship.
Okay, good. Let's move on. Top management at corporations vis-a-vis startups. What's the role of the top management and who might be a good counterpart for the startup CEO? Suzanna, quick.
Yeah. So in our organization, what we do is, depending on deal size, we do get board seats or board observer seats from the startup. And instead of having people inside the investment team sitting on taking those seats, we typically have our senior management team representing the investment unit to be there with the startup. And the level of the individuals that we have in this capacity range from members of the executive committee, like to really to people who are expert in the field where the startups are focusing on. And it's a little bit down to the individual's commitment to the role. Some of them have weekly calls with the startups. They almost treat them like their direct reports. In terms of giving them advice, bouncing off ideas, sharing the almost a little bit of the dynamics of the industry with the startup.
Okay, Josep, anything to add from Mapfre?
Yeah, I think first of all, we have to realize that the startups and corporates are very, very different animals and not well understood from the other side of the table. So it's especially important to the role of translator, of people that is able to understand both realities. I think startups don't usually understand the rules of the corporate, and corporate warriors do not understand the timelines, the aims, and the whole dynamic of startups. So inside the organization, there are appearing a role of as a translator, an interface that is able to make that chemistry work, make those people work together. Coming back to your question regarding the top management, I think it's especially important that the top management provides an umbrella to for those corporations at the initial points are taken care of, or at least not questioned with the same rules that are usually in place for big projects in a corporate.
Sabrina, last item, quick item to add?
Yeah, no, I agree with Josep. We try to match our teams who partner with startups with an executive mentor. However, I would say it doesn't mean that you necessarily have to look for that executive mentor yourself. So if you call our CEO or CTO or any other Bosch board member, that doesn't necessarily mean that you will get a smoother route into Bosch.
Okay, let me add one key item to this. I think this is new probably for all of you. According to a survey we did, is if the CEO, very key, of a large multinational is involved in the decision-making of investment or not, it's 15% lower than if he is not the decision maker on the investment team. Just a little side note, no one is aware of this, but that's the hardcore reality. Let's move on. Speed, speed, speed. We all heard that, as Michiel and everybody else, that we have internal processes, we should make it easier, more friendly, whatever. Remember the tanker and the speedboat. That's the reality. So how to overcome the internal hurdles or the speed? And if I can ask Guenia to start off with your view on speed, speed, speed.
Well, there is not a silver or a gold or silver bullet to this. You have to work on the processes. So we in Telefonica, we have a faster track for startups and companies from the portfolio, wider funds and the direct investments. which means legal, procurement are much easier and faster payment, lighter contracts. And also something that we have been working on last year is to have an easier integration process through open APIs, to have really open APIs, so it would be really easy for startups to integrate, do a quick POC, like plug and play. Also, what we have learned through the years is that it's important to have a dedicated budget for POCs and bridge budget, what we call from one year to the other, because usually the business units don't have it. And the thing is that first year we had to do it by ourselves. Then as time goes by, as the business units start budgeting for POCs and starts to get into the culture. But it's really important to have the open innovation team to keep pushing, the transformation.
Okay, I love that additional. So that's for you entrepreneurs, the key question is when you are with corporates, also ask them how they finance POCs without going to the approval through every single business unit. Maybe quickly, Michiel, on the speed.
Well, I think a lot of things have been said. I'd like to comment a little bit on what I think startups can do better. So for me, it's about being bold towards the corporate as well. I think, as Guenia alluded to earlier, we're great at asking questions. Ask those questions back. And I think particularly on doing POCs or initial work scope, it is super important to build trust and also to contribute to a project that matters, because we've seen on occasion that a portfolio company might work on, say, an asset that's not worth a lot of value to us or might have been abandoned, and they've proven the technology, but not in a business context. So I think as a startup, you need to challenge the corporate as well and ask them, hey, why are we doing this project? Why does it matter to you? And can we publish something jointly on the success of it if we do our work right, for example? So I think getting in on a project that matters, building the trust and learning, from the corporate in the process is essential to sort of hyper accelerate subsequent growth.
I think if I were an entrepreneur, I would hire Michael on my business development team. Good. Last item, last block, a quick one on that one. Let's zoom in once more on POCs, because POCs is a key element for, especially in the B2B space, for a lot of entrepreneurs, and there are a lot of misconceptions there. If I can ask Suzanna, very quick, your view on this within your organization.
Yes, I have a slightly different view, on this than to Martin. For POCs, in my organization, we do have a bias towards doing POCs more for our customers than ourselves. And in this case, we look for startups that has solutions that are production ready. So in a way, if you have to do a POC, really ask yourself, what are the success criteria for a POC to be converted into production? Because if you don't have those criteria defined, it's becoming a very, very difficult discussion when you reach the stage after 6 months. What are we doing? Have we achieved what we've agreed? And so having those understanding defined, like Michael has just mentioned, is extremely important to the extent that if you are a startup who already has customers, who have proven KPIs, try to push for paid production launch and try to get away with any the POC as much as possible.
Michiel, anything to add? She was mentioning you.
Yeah, I think the longer term strategy is really important. So when you're setting out to collaborate with a corporate, also think about what are we going to do beyond this initial phase. So assuming we agree on these success criteria and we meet them, tell me more about the follow-up scope. Where do you have other assets or factories where we could apply this technology as well? How do those business owners feel about this technology? Do you know if are they aware of this technology? So I think you need to upfront have that discussion around what does a roadmap look like beyond the initial success. And then if that doesn't materialize, I think startups also have to be bold in terms of moving on, right? Because if the corporate is too slow, you can get dragged down, get slowed down. And to me, that means we're not a good customer and you should be focusing on others that, provide you revenue.
Sabrina, one last point to add on this you have?
I think everything you said applies to us as well.
Okay, right. So then, quick on next one. Capturing value from investments. This is from a corporate perspective. Guenia, how do you measure it, or the do's and
Okay,
don'ts?
so the hardcore measure is, how much businesses we are doing with the startups, how much we are reselling their services or how much are we buying from them. But this is just the hardcore. No, the important thing is the strategic value of that relationship. Have we created something different that has given us a competitive advantage? Time to market, how was it impacted? Could we shorten time to market by working with this startup? And those ones that are strategics are much more harder to measure. But in any case, we always say we look for strategic returns, but the numbers have to be good as well.
Michiel.
Yeah, I think you've said probably 90% of what's true, and I think for what's important for corporate, certainly when we notice this when just starting out, is you need to be very proactive about speaking to the senior suite about what you're doing, how you're trying to meet these strategic objectives, and I don't think there's a silver bullet in whether there's no right or wrong in terms of whether that's financial metrics or the fact that you're providing new insights about industry trends. But it is important that you do have that continued conversation, because I think otherwise, if you're too internally focused on doing the CVC work and not reporting out on it, your successes don't get noticed. So I think it's important to make sure you maintain that conversation with.
So for entrepreneurs, I can recommend you the following. I think you need to understand from the outset, and you should ask the question, the corporate venture contact that you have. Is your corporate parent focusing on strategic returns or financial returns? It's a different animal. Or are you for a balanced strategy? So then you know whether you fit in well or you can negotiate differently. I'll give you an example. In Japan, we did a survey across every corporate, which is a member of the association in Japan. 82% are pure strategic. This is very different from the Western world. So if you ever deal with Japanese corporates, come and see me while I'm here. I can give you a lot of advice. I used to live in Japan. So last item, 30 seconds each. We have heard all the great stories on the outset. If I can start off with Suzanna, very quick. A failure. What was it and why? And the lesson learned.
Yeah, instead of failures, it's something that we're still trying to work on, is to be able to actually acquire some of our portfolio companies. So I think, it's kind of like moving the last step onto the M&A criteria. How do we match that with ventures criteria in certain ways?
Okay, so on top of it, I'm adding one item. One is getting to the point of acquiring them. The biggest challenge afterwards comes on proper implementation. How closely you integrate, fully integrate, or you keep them relatively loose, and so on and so forth. But that's my view on this. Michiel.
Yeah, so I have a very practical one. I'm still a little bit embarrassed, to be honest. So we invested in a company that manufactures plastic pipe, so it avoids corrosion. It's very lightweight, so you need much lighter vessels, so it saves a lot of cost. And they received a large order somewhere in the world, multi-million-dollar order. Pipe went there, and it appeared that we hadn't done a part of our, call it deployment due diligence. So the pipe actually couldn't be installed to our subsea infrastructure for oil and gas production. So we have a multi-million-dollar piece of pipeline sitting on the quayside. So if any one of you has plumbing problems, then let us know.
Okay, Sabrina.
So one story that comes to my mind is there was a startup. I talked to the CEO afterwards, and he told me he met in one of our locations with my colleagues about 15 times, and all they ever talked about was technology. And so there was, obviously, he was talking mostly to engineers, and we're a technology-driven company, and people love, tech, but at some point we need to do business, and that's what apparently my colleagues in this case didn't really get to. So he spent 2 years talking with Bosch, and eventually moved on to work with one of our competitors. So I think that shows how we really need to speed up to actually approach the speed of the startup in that case.
Okay, Guenia?
Yeah, as any VC, and I look at some VCs in the room, you know that when you have a portfolio of companies, some will go well and some will fail. I can mention some names here, but I doubt that anybody will remember them. So I prefer to go to the lessons learned. I think this was a first one in a corporate environment to
You mean the
learning.
first deal? Or
No, the first lesson learned
A lesson
was,
learned.
that as a CVC, there are things that won't work, and probably a few will succeed, but a lot of them will not. So I think it was a learning process for a corporate to be able to live with that and accept the risks, and because this is a risk business. And the second lesson, the two other lessons learned that I'd like to know to share is that first, it's really important to secure business sponsorship level before we do the investment, so we can deliver to the startup everything that we promise at the beginning up front. And the third one, it's really important with whom you invest with. For us, it really works well when we invest with other financial investors because they bring different things for the table, and we really learn a lot from them, even when we co-invest, like for example with Kibo, which is our partner here in Spain. We bring different things on the table, and you can learn a lot as a CVC as well.
Okay, then finally, Josep.
Yeah, that's one very relevant mistake we've made in terms of opportunity lost. We have had the opportunity to lead CSV of a leading full stack insurer in the insurtech European ecosystem. And I have failed miserably in convincing my bosses of doing that. And actually, we were paying the price of a discounted price over the rest of investors. And they are closing the round finally with a multiple of twice as what we'll have paid. I'm pretty sure those guys are going to reach IPO in less than 2 years.
Okay.
Because I track them very closely. So
Okay, so that said, I think we need to wrap this up, but the lesson learned is actually on both sides. Corporates are learning to deal with startups as much as startups are learning with men dealing with corporates. And by the way, maybe one more thing, if you look over the life cycle of a startup, you will be surprised maybe to hear that in the business-to-business model sector, over 70% of all startups end up by the time they go IPOs, only the ones that IPO, with more than 3 corporates during one of the stages and phases of the development, adding 1 or more corporates down the road. So that is all I can say. I think we need to wrap up. We are a little bit late. Those who have meetings already left, but I hope it was good enough. Let's give a big hand for this panel. Thank you very much.